Hey, what's going on, everyone? Welcome back to another aerial effects video. And in this video, we will be covering episode 2 of the psychology series, all about the fear of missing out, or FOMO. So, this is one of the major crucial topics in psychology because as humans, we naturally want to be included in everything and fear missing out on opportunities. So, before I get into all of this, just a reminder this series will just be covering the surface level stuff, getting you introduced to the aspect of psychology, specifically within your trading. As we know, trading is just about 20% of your overall learning curve and overall profits. And to be quite honest, about 80% of it comes down to the psychology. You can become a very good trader and understand different strategies. But until you manage your psychology and handle your emotions correctly while trading, you are still going to be non profitable. So, this is the biggest thing that many people overlook in this industry is how to control your mind while trading. This is something that is very difficult to learn, but hopefully, I am able to open up certain gateways in your brain that you can see yourself doing, in the sense that you can see the problems that I will be laying out to you here in your everyday trading as I provide solutions to them, and you can begin implementing those on a day to day basis. Now, just as described before, this is just surface level stuff. I won't be going into huge detail. We will save that for our psychology course. That course will be released hopefully by Halloween or October 31st of 2022. And that course will be divulging deep into the concepts, really unraveling some things that you don't even know that you're doing on a day to day basis in your trading that's preventing you from becoming profitable and keeping you in a loss or that break even trader. So, I'm just going to go over some surface level stuff, kind of give you just a brief introductory to these concepts that we'll be going over in way much more depth within the course, but also touching base upon many different facets. That's going to be very interesting and really cool. Very excited for the release of the course. It's going to do complete wonders for you in your trading. So obviously, everyone who is a part of our all-inclusive program will be receiving that course for free, but we are allowing those who are not a part of the program to purchase the course on its own. So I do think this will help you tremendously in your trading and really get you over that hump. So this video is going to be all about FOMO, the fear of missing out. The fear of missing out, or FOMO, is defined as an emotional response to the belief that other people are living better, more satisfying lives, or that important opportunities are being missed. So that's the general definition of what FOMO, or the fear of missing out, is. So we've all experienced this even besides our trading, right? In this world, we are defined by our social status, our financial status. That is what the world has come to. And if we are not included in certain things or afraid of missing out on opportunities that could pass by, we get anxious, we get nervous, we get scared, and we have these irrational emotional responses in our brain that prevent us from making rational, correct, educated decisions. And this does not have to include just trading. This video will go into FOMO within specifically trading, but you can apply this concept of FOMO and the solutions to them in your everyday life so that you are not impacted by this issue. So, in regards to trading, FOMO can be described as the anxiety and anxiousness one feels when an anticipated move begins to leave without them prior to entering into the trade. So you probably know exactly what I'm talking about here. You can probably picture that trade in the back of your mind that you got in a little too late, or really a little too early in the trade, that ended up coming back down and hitting your stop loss or hitting you break even before continuing in the direction you always knew it was going. Well, this is because the market moves in such a way to attract these retail traders into experiencing this fear of missing out. Trading through the institutions is not just taking liquidity and is not just filling orders so that they can continue to make money and move the market, although that is a big part. Another big part is hitting your psychology. How can someone take your money without you being at an emotional disadvantage? It's going to be very hard to. So, when trading, you are driven by your emotional decisions, those things that go through your brain that forces you to make certain decisions that may not even be controllable on your end because you let it control you. Well, that is why the market moves the way it does. It hits upon certain psychology to entice you to take certain positions, and in this case, in FOMO, a little too earlier than you should. So I'm going to go over a beautiful example of what I mean. Now, this is on AUD NZD on the weekly time frame. Now, this can be applied to the 1 minute, the 5 minute, the 15, 20 minute, hourly, 4 hour, daily, weekly, whatever, because the markets are fractal. But I'm going to give you this example because it perfectly represents how FOMO traders think and how they respond to market movements. So as we can see here, we had ascending liquidity. Okay, so this trend line where retail was buying was swept. Liquidity was taken, very strong move to the downside, a very fast push back to the upside, creating that higher high. We broke the counter trend structure because we were originally creating lower lows, lower highs, lower lows. Now we have made that higher high. So now we want to be pulling back down into our level of interest. Now you can be that perfect smart money trader, an institutional trader, and understand that we want to be getting in at the most discounted level where liquidity was first of all taken, but at the same time where the imbalance in the demand was created, where that sponsored move was. And that was right in here. We can see between this wick and this wick here is straight imbalance, and it's just demand. Okay, this is the institutionally sponsored move. This is our area of interest, 1.0350 psychological level. So we know that's where we want to be entering. So you can have the strategy down. This would be that sell side liquidity that you look to take. But when you are a part of this market at live trading at the current time, when price is pushing down, pushing down, pushing down, you're like, okay, cool, I have my buy limit set there. Great. Now I just wait. But when price starts to push back up, especially when it breaks the counter trend, we can see this low, the pullback, lower low, lower high, lower low, lower high, lower low, higher high compared to this previous swing point. So you're like, oh my gosh, I have to get into this trade now because I don't want to miss out on this move. It may not come back down to my entry, so I should just place my buys right now, especially when price pulls back and then continues and makes another higher high. This traps retail longs or even institutional longs, those of you who are trading institutionally, if you are not patient enough to wait for price to come back down into your level of interest. So many people are tied up in the fear of missing out here. The move has already been made. You've already identified the area of interest you want price to come to. You've done the proper analysis. You're trading with market structure. You've taken sell side liquidity here, but your emotions are taking over you and controlling you because you don't want to miss out on this move, even though you know it hasn't come back down to your level of interest yet. So they get in, and then price then reverses right back to the downside, hits your stop loss that you probably put below this low, thinking that we were going to make a higher high, and then price reacts and goes long. And then you are kicking yourself because you already knew that it was going to go long from this level. But you got in too early because you had the impatience and the fear of missing out on this move, which is why we have to understand as institutional traders or just traders in general that there always will be a new opportunity and we have to let it go. If it's not going to come back down into our level of interest that we've done analysis on, move on to the next trade. And I know it's easier said than done, but in all reality, if you know your strategy works, like institutional trading absolutely works because it is proven it's the way the markets actually are moved and manipulated, but your risk to reward is going to increase. And if you have a high win rate, you know your strategy works. Why even attempt to trade against your rules and your trading plan, knowing that you didn't even hit your overall entry? Don't have that fear of missing out because 90% of the time it's going to come right back down into that level of interest. The reason why we had that level of interest there was because of all the confluences that we had. So if the confluences weren't there for a trade in here, it's just meaning it's probably going to create this low, a lower high, and then another lower low, having this sort of counter trend pullback into the overall level. But we were so inclined and enticed to place trades in here because you thought, oh, we swept sell side liquidity. We just missed our level of interest, and now we're pushing. We're pushing very strongly. We're going to miss out on this move. We need to get in right now. That is the worst mindset to have in trading. Stick to your rules, stick to what you know works, stick to your entry. If it doesn't hit it, move on to the next one. We can also see in here shoulder, head, right shoulder. More retail is enticed to take shorts below the neckline, and then look what happens. Right back to the upside, retail loses again. So that's how, even if you are a smart money trader, you can still lose if you don't maintain proper psychology in your trading. This stuff happens all the time. The markets are designed to make you lose, to shake you out of the trade and make you lose so that the institutions, the ones who are moving price, can win. But if we can manage our emotions with a proper strategy, we are going to be undefeated. There are different types of FOMO out there. There's fear. As the name states, fear manifests simply because participants are usually afraid of future regrets. So you're fearful that you're going to miss out on a move and potentially miss out on huge profits, maybe even potentially passing a challenge or hitting an overall percent return goal. So you're fearful in that sense, and then you take irrational trades that don't even make sense simply because you see a move already happening. But in all reality, by the time that you get in, the move has already occurred. Then there's greed. There's usually greed in FOMO simply because the trader wants to make as much money in the quickest amount of time. You always want to be involved in the market, right? So when you see a move happening, in your mind, you're thinking, there's so much money to be made with this trade. It's absolutely mooning or it's absolutely dying, whichever direction it's moving. I don't want to miss out on all this money that I could be making. So the greed factor comes in and you enter trades not even understanding where you should be actually entering, simply entering based upon what the market is doing at that current time. But is that the right area of interest to be looking for? Then there's anxiety. There's anxiety in FOMO because traders are anxious about being left behind by the rally. This is probably the biggest thing. No one wants to miss out on anything, whether that be an entry in trading, whether that be an event with friends, whether that be, anything that's going on in your life. You always want to be included, because if you're not, you feel insecure, like those people or group of people or a specific person doesn't want you to be a part of that. And then you question if you're doing anything wrong, right? This is how the brain works. So with anxiety, you have that anxious feeling when you're seeing price move away from your trade and it hasn't come down or up to hit your entry. And so you're just so scared that it's not going to come back down, and you don't want to miss out on the rally. So you enter at a worse price, and then price then reverses, comes back down to your original entry, and then maybe hits your stop. And then you're kicking yourself because you let your emotions get the best of you. Then there's jealousy. In many periods, FOMO traders tend to be jealous about the performance of their friends or other traders. You can't lie, you've been there before. You've been jealous when your friends are performing better than you in the market. You've been jealous when you see someone else, maybe a more influential trader online, performing a lot better. You want the lifestyle they have. You want that supercar. You want that financial freedom. You want all that stuff, which just in turn creates the fear of missing out on the potential performance that they're getting, thinking that you can get the same results too, right at that instant. So that's when you're just entering a bunch of trades trying to make a lot of money. That's just one example. And then a lot of times impatience, and this, we were going back, to AUD NZD here. This is the impatience part. Okay. You're impatient and not willing to wait for the overall pullback into this level because you think it's going to rally and continue. So many times FOMO traders are usually impatient simply because they are not disciplined. This is a perfect example of a non-disciplined trader. This is your area of interest. Why would you be entering in here? Disciplined traders either wait for price to return before they enter, or simply don't enter at all. And then they go on to the next setup because there will always be new setups like this. The many causes, there are so many different causes for FOMO. Winning streaks and losing streaks. Biggest one, it's not just losing streaks, guys. It's when you're on your winning streaks too. So winning streaks hype up your ego, gives you that hothead mentality. You feel invincible. You feel like you can't lose. You therefore make an irrational decision, and the market humbles you very quickly. Now, losing streaks, on the other hand, cause you to deviate from your rules to make up for the losses you incurred. This in turn leads to over leveraging, over trading, getting it at the worst possible price, and being emotionally attached to the trade when the market is just going to run all over you. Because the market has no remorse for you. They don't care who you are. They don't care what you look like, how much money you make. It doesn't care. It's there to take your money. Now we have to beat the market by handling our emotions correctly. Okay, the industry as a whole. Oops, let me go back. Excuse me. The industry as a whole. Really, this is huge. And this is something that is a big problem, especially in the Forex industry, because this is why the Forex industry gets such a bad rep, because it's full of scammers, full of fake profits, full of fake entries, fake lifestyle. It just creates a sense of false hope, and it sets unrealistic expectations, especially for beginner traders or even more intermediate traders. When you see stuff like this online, take a step back and have a little bit of a different perspective. Why are those people posting all these profits, maybe faking their entries? If you see like 100 standard lots, do you really think that they're actually trading that live? Fake lifestyles. When people are posting all about their cars and all about everything, do you really think that that's real? I mean, normally, if you're actually that wealthy, you're probably going to keep that private, right? You go ask any multimillionaire and billionaire of the world, they're not flaunting all their stuff. And if they are, they're immature. They're very reserved, very private. That's how they maintain their wealth, maintain their level of security, right? This creates a sense of false hope, right? Thinking that you can do it too. So you then chase this dream and these unrealistic expectations, leading you to chase trades and over leverage and then blow your account because you're not doing it the right way. This will ultimately lead to your doom. Understand how the Forex market and the Forex trading and investing first works, right? Use your common sense when you're looking at stuff like this. So when you're presented with all these crazy profits that there's no way in the world these people are actually doing consistently, and it's just enticing you to join their group and take your money, what is that actually doing for you? It's trying to hit that emotional side in your brain to tell you, hey, look, I can do this too if I pay this person for his course or for his service or whatever they're selling, right? So understanding that, we can make better decisions about what we listen to and what we don't listen to. Understanding the Forex market is a very difficult market to trade, just like any market out there. No financial market is going to be easy. If it was easy, everyone would be doing it. But at the same time, the markets don't move like that because they're designed to make you lose. The institutions move the market. They have the order book. They know exactly where you're getting in. So what they do is they just wait for a group of people to get in at a certain price with a certain volume of liquidity above or below a certain level, and then go and run it. So you're ultimately doomed from the get-go. So understand how the true nature of order flow works first. Use your common sense when it comes to looking at these fake profits and fake lifestyles that many people portray online, right? That's why we don't post lifestyle pictures. We really, really don't, because we don't need to. Why? Because all the proof of my credibility lies in the analysis that I provide to my clients. That speaks volumes in and of itself. I don't need Lamborghinis to tell me I'm a good trader. I just take good trades and I send them out to my group. So you're looking at from the wrong perspective, because that's how so many people respond to these groups. They want to see Lambos. They want to see lifestyle. They don't care if you're a good trader. If you have a Lambo, then oh my gosh, drop everything. How much do I pay you? That's what people think, and it's so bad. You have to be with someone who actually cares about your growth, who is actually a good trader, who has good morals, who actually understands the movements of the market and can provide proof to this. Right? So I'm not trying to, boast myself here, but I mean, I even created a video a little while ago about how we did 59.6% return in the month of September. Literally did a full audit of our entire VIP channel, going over every single piece of analysis and trade. No one else would do that because everyone else is fake. Ask your mentor. If I'm not your mentor and you have a different group, ask them to do that. They'll be like, yeah, sure, and they'll never do it because they know deep down that all of their trades, they just pick and choose the winners and post those and market those. Do a full audit. They won't do it because they know they're fake. So we have to take special care and consideration when it comes down to all this stuff, because this will ultimately lead you to chase this dream that's not really feasible at this current time for you, because trading takes years and years of experience before you can really grow in this skill. And it takes a lot of failure. It takes a lot of learning. So this ultimately leads to the fear of missing out on what everyone else is doing. That's how I can tie it together. There's also news and analysts. These people, these fundamentals, these sudden spikes in price creates an impulsive emotional reaction, ultimately causing you to enter after the move has already been made. Let's think about that for a minute. When you see price move very quickly, what are you naturally inclined to do? You don't want to miss out on that move. If you think price is going long and the news comes out and then price is pushing up very strongly, you just want to get in. You don't want to miss out on that potential move. At that point in time, you've already missed the move. Price is already too far gone to the upside to get a good entry with a good stop loss with a high risk reward. So why enter the trade? Because you're going off of your emotions, that emotional attachment to your predetermined bias. That's what feeds the FOMO, is when you already have it in the back of your mind that price is going to go a certain way, and then it starts to go that way, and it's leaving without you, you impulsively just press the buy button if you're looking to buy, sell button if you're looking to sell, getting in at the worst possible price. Then price reverses, comes back down to its original level, and then continues in the overall direction. And then you lost, but the psychologically disciplined institutional traders are winning every day. Then there's social media, and I can't stress this enough, guys. If all you do is sit on social media, on your IG, on your Facebook, on TikTok and all that stuff, trying to find the holy grail strategy, or just trying to find a bias for whatever you're currently trading, it causes information overload. Information overload is a byproduct of these social media platforms, but it creates the predetermined bias surrounding a particular pair or pairs, and then you chase that trade not wanting to miss out on what everyone else is doing. But we know as institutional traders, don't follow the herd, don't be sheep. Observe the masses and do the opposite. So if everyone else is selling Euro USD, what do you think is probably going to happen eventually? There's going to be probably a huge move to the upside, sweeping all that liquidity. So we can't let social media impact our decision making. You need to learn it for yourself and be confident in what you know works. Because if you let social media, create that predetermined bias for you, it's all based upon the emotions. It's hitting your psychology hard. And the stuff that you don't even know that you're paying attention to is really negatively affecting you. So how can we eliminate it? And it simply comes down to being disciplined. It comes down to having a trading plan. You need that overall plan. This includes all the direct and indirect trading relating procedures. Obviously, a trading checklist, which is confluences that must be met before a trade can be opened, is a part of your trading plan. So a trading checklist is just a subcomponent of the overall trading plan. A trading plan is everything from time of day you're trading, what pairs, what risk you're using, how many pairs can be open at once, just all these different things that go into your trading. But then the trading checklist is like, okay, well, what criteria needs to be met before a trade can be opened? I need to look at the higher time frame and need to see the overall direction. Is the lower time frame in conjunction with the higher time frame? Are we pulling back into an area of discount or premium where I can get the best possible price? Am I trading in the right time of day? Is there liquidity that could trap me? Or am I going based off of a liquidity sweep that I saw? Am I trading off of a mitigation? Is there imbalance? Is there supply and demand? All these different things that can add up to be huge for a trader are not there because they don't have a trading checklist. So this whole FOMO thing can easily be eliminated if you stick to a trading plan and have a proper one. Journaling is also very important. Proper documentation of your trades allows for you to clearly reflect and visualize any recurring patterns or mistakes you may be making. It also, helps to learn from each individual trade so you don't make those mistakes again. But at the same time, if you're seeing a pattern and seeing the same mistake over and over and over by going back and looking through your journal of all the trades that you've taken, you may see, okay, I know the reason why I'm not profitable is because this, or this, X, Y, and Z, whatever. Having a trading routine. Routine is huge in trading. Trading, like I said, for many other videos in the past, is supposed to be boring because it's the same thing every single solitary time. So when you're constantly doing different things, the market is just going to humble you very quickly. You need to be routine. It needs to be the same every single day. Keeps you disciplined and prepared for the trading day ahead. And then obviously stops and multiple take profit levels are very important. This eliminates the emotional attachment you have to a trade. Please use a stop loss, guys. With proper risk management and a stop loss, you're not emotionally attached to the trade because you know the stop loss is there. Also, if you're splitting up your positions into multiple different take profit levels, you can maximize your profit along the way. How do you properly do this? Set your take profit levels at areas in which could potentially reverse from your trade. If you're trading long, right? If you're buying, look to see, okay, where could price potentially look to short off? Where could it come into to short off? Lower and higher time frame. Place your take profits at those levels. You're not emotionally attached to the trade because you're not over leveraging and you have a stop, and you're maximizing profit along the way when it goes in your direction. All right, so the exercise for disciplined traders. And then I'm going to go into this Bitcoin example here. So stay tuned for that. It's going to be cool. Exercise for disciplined traders. How can we be more disciplined and not let our emotions and the fear of missing out impact our decision making within trading? First of all, educate yourself, guys. There's so many people who jump straight into live trading or want a passive prop firm challenge immediately because they have that instant gratification feeling and they want to make $1 million overnight. That is the worst thing you can do. That's why so many people consistently lose money in this industry. I've asked so many people over the years, how long have you been trading for? And why do you think you're not profitable? Number one answer for how long they've been trading is 3 to 4 years, maybe 5. It doesn't need to take that long because you're just going through the same crap. You're doing the same things and expecting different results. If you keep doing the same things, you're going to keep losing. So you got to change something. Educate yourself properly, right? And it may result in you upfronting some money to invest in education. That is what may be necessary for you. Trying to do it for free is going to be really difficult sometimes because you're not getting the right information, being mentored by the right person. And the most common question for why people are failing is, oh, I haven't found that strategy yet that works for me. It's not the strategy that's bad. It's you who don't have the discipline and the understanding and the adversity, or to be able to handle the adversity in order to make it work for yourself. Because you think if you can take a course and immediately apply it, you should be immediately profitable. That is not how life works. That is not how trading works. If you think it is, good luck to you because you're not going to get anywhere. And I'm straightforward with you. I'm a very straightforward person. So I don't care if you think I'm a jerk. I really don't care because I teach people the right way and I'm straightforward with them. That's why my clients succeed. I'm not going to sugarcoat anything for you. I'm not going to say, oh, you can keep going, just keep going, don't give up. I'm not going to do that. I give you information. I tell you how it is. If you come to me asking for help, I'm going to help you. If you're doing it the wrong way, I'm going to correct you until you get it. That's how you become a profitable trader. You need someone like that. So educate yourself first. I don't care. You don't even have to, you know, we have courses and a mentorship that is top tier, but you can join anyone else, but make sure you educate yourself first. Invest in your education, whether that be with someone else or me, doesn't even matter, but make sure that person is the right fit for you. Understand the process of becoming a professional trader. It is not just practicing a strategy for 1 or 2 months and then reevaluating your ability. Trading takes years to master, and it first starts off with your psychology. So I'm really, upset with myself for not coming out with this course earlier. I should have, because psychology is probably the most important thing to understand first. But practicing proper psychological techniques that we'll be going over into way much more depth within our course. This is very just surface level stuff here, but that is really what's going to help you unravel the mystery behind your brain and why it does certain things and how you can take control over it instead of having it control you. Ask yourself, how many temptations of this world do you feed into every day? I'm not going to name them because there are a lot of bad ones here and I want to keep it PG, but what are the temptations in your everyday life that you feed into? And you keep letting it control you. It's the same thing with trading. You keep doing the same things and expecting different results. Understand the process. It's a process. That's why I said the process. It is a process. There's a step-by-step, well, not really step-by-step, but we provide a step-by-step to make it easy to understand. Process of becoming a professional trader. It's not going to happen overnight. And understanding that the worst traders are the traders who feed into the fear of missing out. They always want to be with everyone else. They don't want to miss out on any single move in the market, regardless of if it goes against their rules, goes against their risk management, goes against their trading plan, goes against everything, because they just want to be involved. That is going to lead to your ultimate doom. Develop a set of rules for entering into a position. You need a confluence checklist because you need something right beside your desk every morning. If you're entering into a trade, you can see that checklist. You can check everything off. If everything meets your confluence checklist, then it's safe to say that you can enter into that position. Maybe if you have 10 confluences, maybe you set like 6 or 7 to say, okay, if I hit at least 6 or 7 of the confluences, it's good enough for me to enter the trade. Create a well thought out trading plan. It needs to be well thought out, and it needs to be descriptive, and it needs to be followed. Paste it above your wall, right beside your trading laptop or screen or whatever you're using to trade. Have it with you all the time and document all your trades. This is very important. Before and after screenshots. It's going to help you learn. But the before screenshot, describe why you're looking at entering, all the confluences you have. Then post your after screenshot. You can even do this in Excel. You can do this in PowerPoint, whatever. Just keep track of them and understand, why did I win this trade? Why did I lose this trade? Why did I not take profit here? Why did the market reverse here? And learn from it. Because if you can start seeing patterns that negatively affect you, you can then learn from those and you won't have to make them, control you again. Hold yourself accountable. Biggest thing. Because it's ultimately up to you. No one can do it for you. I can't trade for you. No one else is going to trade for you. No one else is going to say, hey, bro, you need to reduce your risk. Or, hey, bro, you're just being emotional with this trade. Let it go, whatever. No one can do it for you but yourself. So it's ultimately up to you. Are you following all of this stuff? Now, there's probably a lot of other things here that I could talk about, which I'm not going to because I'm saving it for our course. But you have to be able to hold yourself accountable. Are you doing what's necessary for you to become a professional trader? Because if you want to trade, you can't really do it as a hobby. It's either you're all in or you're all out. Because if you just do it here and there, you're not really learning, you're not really practicing, and you're just gonna keep losing money. So it's an all in or all out thing. Understand the habits of the professional traders, learn from them, and hold yourself accountable and practice them. So if you need a trading plan, just ask for ours. I would be happy to provide you with ours. That's why we have it, to give it out for free, because it's so important to have. So definitely, if you need one, just ask. I'd be glad to give you mine. It's a proprietary trading plan, specifically for smart money trading, how Ariel affects trades. Be happy to provide it. Just hit me up. All right, so the last slide here, let's talk about how the institutions use our psychology against us here. So in the beginning of the video, I mentioned that, the markets are moved based upon liquidity and volume, obviously, but also about how to best use your psychology against you here. So remember back in 2018, 2017, the Bitcoin run went all the way up to like $20,000, right? That's when Bitcoin was huge, right? Then all of a sudden it crashed. Okay. Why did it crash here? Well, it's because the hype around it. Everyone was buying it here. By the time price was already up here, it's already made its move. So what happens? Everyone buys in because it creates that hype around it. So when everyone gets in a certain direction, what do you think the institutions are going to do? They're going to come back down and take your stop and force you to sell your position back down here. Because if you buy it up here, they're going to want to get the best possible price to free up the liquidity so they can buy it down here. In all reality, they're just scaring you to get out thinking it's going to absolutely crash. It's how the market moves. That's why we have these swings and pullbacks and swings. It's a psychologically driven market, right? And this is a picture of psychology. Just like I had in my original video. I'm like, can you draw a thought? You can't draw a thought because the thought's not physical. Well, this is the exact representation of everyday thinking, right? It's a piece of artwork. So they use psychology to entice you to take specific trades in certain directions at certain times against you. They use psychology against you to get you into position so that they can go and take your money. That's exactly how it works. So when price is selling off, everyone's like, okay, I got to get out. I'm selling my position back to the market here, getting out at the worst possible price. Then the rally occurs. You're like, crap, I got to get back in. Nope, right back to the downside again. So now you're okay, I'm staying out of Bitcoin. Just kind of chops around. And then 2021, at the end of the year, there was so much hype around it. I mean, there's everything. I mean, there's Dogecoin, which is complete crap. There's Bitcoin, there's Ethereum. Everything is mooning and skyrocketing. And right when someone says, hey, let me give you a hot tip. You need to buy this here. You need to buy that here. You better be scared and run because the crash is coming. If everyone becomes these sudden investors, hey, I'm an investor. I'm making so much money. I'm rich. Hey, buy this, sell this. Wait for the crash because it's coming soon. That's exactly what happened. Okay, go against the herd. Don't be a sheep. If you're a sheep, you can't complain about losing. Okay, so when price was pumping and pumping and pumping, boom, sold right back to the downside. Get people out. Pump, builds the hype around crypto and everything. Boom, right back to the downside from 69,000, that was the high, all the way down to where it was when I took the screenshot at about 19,000. Now, everyone who's been buying in here from the hype because they're scared of missing out on the move has already occurred, ladies and gentlemen. It's done. Why are you getting in here? I had buy limits way down here. I still have buy limits down here. I think price is coming to 10,000. Why would I be buying up here at premium price? Same thing with trading. That's why we use fibs. The only reason why we use fibs is for, are we entering in premium or discount? If we're buying, you got to be entering a discount. If we're selling, you're entering a premium. You don't want to buy something at a premium price. You want to get the best bang for your buck. Same thing with if you're selling something. You want to get the best bang for your buck. You want to sell it at the highest price possible. Right? So they're enticing you to take trades, the hype around it. That's why they're coming out with all these crypto platforms and everything, because it's just like sports betting, right? You see all these commercials online for sports betting. Sports betting is a playground for these casinos. The odds are so against you that they're promoting this stuff to try to get you to do it, offering you all these incentives, enticing you to get in, and then you lose your money, and then they win because they knew they were always going to win, which they will. Same thing with trading. They hype it up, social media, all these different things. They pump price, gets you to buy, and then everyone was in from here. I don't know how many people said, oh, buy Bitcoin up in here, buy Bitcoin up in here. It's at all-time highs. Why would you buy at all-time highs? Are you that dumb? Like, seriously, be real with yourself. Why would you buy up here? I don't care if price just continued. It's a bad mentality to have. Because at the end of the day, if price does actually go down, which we knew it probably would, you're losing all your money. That's why the most millionaires are made when the market crashes. And when everyone else is pulling out of the stock market or pulling out of their crypto funds, whatever, The big banks and institutions, the real entrepreneurs, the real investors are buying more. When everyone's scared, I love crashes. I hope we go into a recession. You know why? Because it's going to completely crash the market so I can buy more. Now, I don't wish for a recession because that's going to impact a lot of people negatively. But I love when the market crashes because then I can get in at the better price. So, guys, this is how the institutions use our psychology to influence our everyday trading, especially with the fear of missing out. Everyone wants to be included. Everyone, wants to be a part of something, and they're scared of missing out on the opportunity. And when they're seeing it live, they get in, and then the market reverses because the move has already been made because they got in late. All right. So, guys, I hope you took some value from this and can apply some of this stuff into your everyday trading. Again, this is all surface level. I don't go into too much detail and give too many examples or go into all the different components and all the nitty gritty facets of psychology. But that's saving for my course and everything. But I want to give you as an introductory. So, if you wanted to take that step further, we are definitely here to help you with that, an understanding of psychology, but also so you can understand just some basic problems that you may be facing in your everyday trading that you can start to work on to become a better trader. So, guys, thank you guys so much, and stay tuned for episode 3 coming out soon. Thanks so much.